So I want to start off today with a story, a really wild story from back in 2007, because Warren Buffett, and we all know Warren Buffett, he made this $1 million wager that basically just completely humiliated some of the smartest, most highly paid financial minds on Wall Street.
Oh yeah, the famous hedge fund bet. It's legendary in the finance world.
Right. He basically bet that a completely dumb, robotic list of companies could beat a hand-picked, heavily researched collection of elite hedge funds over a 10-year period. And he didn't use like a secret algorithm or insider trading or anything like that.
No, not really.
He used a tool that literally anyone listening to this right now has access to on their smartphone. And spoiler alert, he won by a landslide. So today we are doing a deep dive into a massive stack of financial data, historical market records, all of it, to figure out exactly how that so-called dumb list actually works.
And, the list we're talking about is obviously the S&P 500, which is funny because it is probably the most frequently cited acronym in modern finance.
Yeah.
But at the same time, it's one of the least understood by the general public.
Oh, absolutely. I mean, you hear it every single day.
Exactly. You turn on the evening news and the anchors talk about it like it's the weather. They're like, oh, the S&P 500 is up today, or the S&P 500 is facing headwinds. But they never actually pause to explain what those letters and numbers actually mean for, normal people.
Right, because the financial industry kind of thrives on having this exclusive vocabulary. It's like, well, think about it like getting on an airplane. The pilot doesn't get on the intercom and give you a lecture on the thermodynamics of jet engines, right? You just buckle up, you trust the physics, and you get there.
Right, you just sit back.
But with the stock market, everyone from cable news pundits to like those online finance gurus, they just assume you naturally speak fluent Wall Street. They just yell, hey, just buy the S&P 500, as if that means anything to someone who hasn't even opened a brokerage account before.
Yeah, and it creates this massive barrier to entry because the people who finally do learn the terminology, they suffer from the curse of knowledge. They completely forget what it felt like to not know the difference between an ETF, a mutual fund, and an index. So that basic ground level explanation just never happens.
Yeah, people just nod along at dinner parties to look smart, and then they go home and leave all their savings in a regular bank account, just losing money to inflation because the mechanics of it all feel way too intimidating.
Which is tragic, honestly.
It really is. So we are tearing down that barrier today. That is the entire mission of this deep dive. We are going to be your translator between all this Wall Street jargon and actual practical wealth building. So if you're listening, by the end of this, you are going to understand exactly what the S&P 500 is structurally, the math behind why it's basically the greatest wealth building engine in history, and most importantly, we're giving you the exact step-by-step playbook to start using it today, even if you are a total beginner.
And honestly, the most empowering part of all this is that once you pull back the curtain, the stock market stops feeling like this unpredictable casino. It really just becomes a highly rational, measurable system.
So let's start right at the bedrock layer. Strip away all the flashing red and green arrows on the TV screen. What is the S&P 500 fundamentally?
At its absolute core, it is simply a list. That's it. It tracks the 500 largest, most established, and most economically significant publicly traded companies in the United States. It's basically a gauge of the health of corporate America.
Right. So we're talking about Apple, Microsoft, Amazon, Google, Walmart, JP Morgan, and like 490-something more.
Exactly. But it didn't just pop into existence out of nowhere. There's a real corporate architecture behind it. The letters S&P actually stand for Standard & Poor's, which is a financial analytics company. We know them now as S&P Global.
And the history of this list goes way back, right? Like the 1920s.
Yeah, 1923, a firm called Standard Statistics started tracking this small index of about 233 companies. And their whole goal was just to give investors a broader picture of the market rather than just obsessing over individual stock prices. Then, in 1941, they merged with Poor's Publishing, which gave us Standard & Poor's.
Got it. And then the modern version, the one with 500 companies, that launched in 1957, which makes a lot of sense historically.
Oh, absolutely. Think about what was happening in 1957.
Right. The post-war industrial boom, tracking just a handful of railroad companies, just wasn't cutting it anymore to measure the American economy.
Exactly. The economy was exploding, becoming way more complex. So they expanded the list to 500 companies to get a true cross-section of the domestic economy. And just a quick bit of financial trivia for you here. The index actually contains 503 constituents today, not 500.
Wait, really? It's called the S&P 500, but it has 503?
Yeah. It happens because a few companies have multiple share classes listed on the market, like Alphabet, the parent company of Google, They issue both Class A and Class C shares. But economically speaking, you're still looking at the performance of exactly 500 distinct corporate entities.
Okay, that makes sense. And the sheer scale of these 500 entities is kind of mind-blowing. Like, looking at the data from our sources, these 500 companies make up roughly 80% of the total value of the entire U.S. stock market.
Which is a crazy concentration when you really unpack it. I mean, there are thousands of publicly traded companies in the U.S., little regional banks, biotech startups, retail chains. But these 500 behemoths carry so much financial gravity that they literally account for 4/5 of all the public equity capital in the country.
Wow.
Yeah. And that density is exactly why macroeconomists and the federal government treat the S&P 500 as the ultimate barometer for the nation's financial trajectory.
And it's used as a leading indicator, right? I feel like we should clarify what that means, because when you turn on the news, you hear about the GDP or the unemployment rate, but those are lagging indicators.
Right, exactly. The GDP and unemployment are basically a historical autopsy. They tell you what the economy was doing 3 months ago or last month.
Yeah.
The S&P 500 is completely forward-looking.
Because the stock market is basically pricing in the future.
Exactly. The price of the index today isn't based on what these 500 companies did last year. It's an aggregate calculation of what millions of investors expect these companies to earn in the future. The Conference Board actually uses the S&P 500 as one of its 10 leading economic indicators, specifically because it prices in those future expectations in real time.
Okay, so we've got this massive list acting as the pulse of the American economy. But you can't just be a huge bloated company and buy your way onto this list. There is a gatekeeper.
Oh yeah, a very strict gatekeeper. It's a formal governing body called the S&P Dow Jones Indices Committee. And they meet regularly to evaluate the companies on the list, and they decide who gets to stay, who gets kicked out, and who gets invited in.
See, I like to visualize this whole thing as a highly exclusive VIP club. It's not just about having a ton of money. There's literally a bouncer at the door meticulously checking your stats. And you have to meet a very strict set of physical and financial criteria to get past that velvet rope.
The bouncer analogy is perfect. And the criteria are rigorously defined to protect the integrity of the whole index. First off, you have to be domiciled in the United States. And you must have a market capitalization, the total value of your company, of at least $18 billion.
Let's just pause on that number. $18 billion, that is the floor.
Just to be considered.
Right. So that immediately filters out thousands of mid-sized companies. It ensures that only corporations with massive infrastructure and huge market share are even allowed in the door.
Exactly. And on top of that, your stock has to be highly liquid.
Okay, translate liquid for us in this context.
Sure. In market terms, liquidity just means that millions of shares change hands every single day without the stock price swinging wildly. Like, if a massive pension fund needs to buy $50 million worth of shares right now, they need to be able to do that instantly. If a company's shares are mostly locked up by founders and rarely trade, they're considered illiquid and way too volatile for the index.
Got it. But there's another rule, which I think is the most important one the bouncer enforces, the profitability rule.
Yes. This is massive. A company has to report positive earnings over the trailing 4 consecutive quarters. The sum of those 4 quarters has to be positive, and the most recent quarter individually has to be positive too.
Which is such a good safeguard, because during those huge tech booms, you always see these flashy startups getting astronomical valuations from venture capitalists, but they are secretly burning through billions of dollars in actual cash.
Right, they're operating at a massive loss just to gain users.
Exactly. But the S&P 500 bouncer doesn't care about your visionary CEO or your trend yap. You have to prove you have a real, profitable, sustainable business model before you get in.
And the kicker is, even once you're in the club, your VIP status isn't permanent.
Right, the quarterly rebalancing.
Exactly. Every 3 months, the committee looks at the roster, and they evict companies that are deteriorating, and they bring in the rising stars that finally hit all those criteria. It makes the index this dynamic, self-cleansing organism.
And our sources gave us a really concrete example of this. Let's look at the actual rebalance from April 2025. I think this is such a fascinating snapshot of how the economy actually evolves in real time. Who got past the bouncer and who got thrown out?
Well, in that April 2025 reshuffle, the committee added Coinbase, which is obviously the massive cryptocurrency exchange. They added DoorDash, the food delivery network.
Yeah.
And they added TKO Group Holdings, which is the conglomerate that owns the UFC and WWE.
Just think about what that says about modern American consumer habits, right? A crypto exchange, a gig economy app, and a mixed martial arts promotion company. Like,
Yeah.
that is the modern economy.
It really is. They finally hit that $18 billion threshold, they had the liquidity, and they proved they were consistently profitable. But since it's a strict list of 500, to make room for those three others had to fall out.
Who got the boot?
Discover Financial Services, Borg Warner, which is an automotive parts manufacturer, and Celanese, a materials company.
Yeah.
Usually when companies get removed, it's either because their market cap shrank relative to the rest of the market, or they went through a merger that changed their structure. They just couldn't keep pace.
It's wild to look at the historical data. Like, if you look at the S&P 500 from the 1970s, it's all oil conglomerates and steel manufacturers.
Right, and legacy automakers.
Yeah, and today it's completely different. And the beauty of it is the index automatically purges the obsolete companies and absorbs the innovative ones, and you, the investor, don't have to lift a finger to manage it.
It's entirely automated on your end. But that structural reality brings up another really critical concept. Being in the VIP club doesn't mean everyone gets an equal voice. We need to talk about how the power is actually distributed inside the index.
Yes, the math behind it. Because the S&P 500 is what Wall Street calls a market capitalization weighted index.
Right, or market cap weighted. Market cap is just the total dollar value of all a company's outstanding shares, basically the price tag of the entire corporation. And because it's market cap weighted, a company's influence in the index is directly proportionate to its size. The bigger the company, the bigger its slice of the pie.
So let's ground this with a real example.
Yep.
Our sources break down the math using Apple from November of 2025. Walk us through that.
Sure. So to find Apple's market cap, you just multiply its current stock price by the total number of shares out in the public market. In November 2025, Apple had about 14.76 billion shares outstanding, and the stock was trading at $268.56 a share.
So you multiply 14.76 billion by 268.56.
And you get a market cap of roughly $3.97 trillion.
3.97 trillion. It's almost hard to even comprehend that amount of wealth concentrated in one company.
It is staggering. So to figure out Apple's actual weight inside the index, you take that 3.97 trillion and divide it by the total market cap of all 500 companies combined. At that specific moment, the entire S&P 500 was worth about $67.73 trillion.
Okay, so 3.97 trillion divided by 67.73 trillion. That's roughly 5.8%.
Exactly. And that 5.8% figure dictates where the money goes. If you invest $100 into an S&P 500 fund, the algorithm automatically takes about $5.80 of your money and buys Apple stock directly.
I always visualize this as like financial gravity. The bigger a company gets, the stronger its gravitational pull becomes. Apple's stock price goes up, so its market cap goes up, which means its weight in the index increases. So every new dollar that any investor puts into the index is forced to buy even more Apple stock, which pushes its price up even more.
It's an incredible self-reinforcing feedback loop. But that same gravity has created a really profound structural anomaly recently. When you look at the very top of the list, Microsoft, Apple, NVIDIA, Amazon, Meta, you find this severe top-heavy situation. By early 2025, just 10 stocks made up nearly 35% of the entire index's value.
Wait, hold on. This is where I have to push back.
Go ahead.
Because everyone sells the S&P 500 on the idea of broad diversification, right? You're supposed to be spreading out your risk across 500 companies. But if over a third of every dollar I invest is just going straight to like 10 tech CEOs in Silicon Valley, is that really diversified? Doesn't that seem incredibly precarious? What if the semiconductor industry crashes or regulators break up big tech? Doesn't my whole portfolio tank?
That is a very valid concern, and it's heavily debated among institutional investors right now. To give you some context on how severe that 35% concentration is, we have to look back. The last time the market was this top-heavy was the height of the dot-com bubble in 1999. And even then, the top 10 only made up about 25% of the index.
So 35% is literally unprecedented.
Completely unprecedented. And yes, it absolutely introduces sector-specific risk. If those mega-cap tech giants have a terrible quarter, they will drag the entire index down with them, even if the other 490 companies are doing great.
So what's the alternative? Is there a mathematical workaround for someone who wants the 500 companies but doesn't want their life savings dominated by 5 tech giants?
There actually is. It's called the Equal Weight S&P 500. It's a parallel product. It takes the exact same 500 companies, vetted by the exact same bouncer, but it completely throws the market cap weighting formula out the window.
Oh, interesting. So how does it distribute the money?
It just assigns a flat, fixed 0.2% weight to every single company on the list.
So Apple gets 0.2%, and the absolute smallest company, the one barely scraping by that $18 billion cutoff, also gets 0.2%.
Exactly. If you invest $100, every single company gets exactly 20 cents.
Wow, that's fascinating. Does it perform better?
Well, it acts as a really interesting control group. During massive tech bull markets, like the 2010s, the traditional market cap index destroys the equal weight one because it lets those tech giants just run wild. But during periods of severe volatility, the equal weight index often wins. Like in 2022, when the market was incredibly volatile, the equal weight index actually outperformed because it was mathematically insulated from the massive crashes that hit the big tech stocks.
It's like a better shock absorber for your portfolio.
Precisely.
But okay, whether we're talking about the market cap version or the equal weight version, if 35% of the money is in Silicon Valley, we still need to know what the other 65% is doing. What happens when we look past the software and the microchips? What does the rest of this economy actually look like?
To do that, we have to look at the GICS, the Global Industry Classification Standard. It's a system that categorizes all 500 companies into 11 distinct economic sectors. And this is where you see that the index is so much more than just a tech portfolio. Yes, information technology is huge, around 30%, but right behind it, you have financials and healthcare, both sitting around 12 to 13%.
Okay, so the financial sector, that's like the plumbing of the global economy.
Right.
JP Morgan Chase, Visa, MasterCard, Berkshire Hathaway.
Right. And healthcare is all the massive pharmaceutical pipelines and medical tech. Eli Lilly, Pfizer, United Health. Then you move down the list to industrials. These are the companies building the physical infrastructure of civilization.
Like Caterpillar, John Deere, Boeing.
Exactly. And the materials sector. Now, this isn't just, raw gold mining. Our sources highlight Ecolab as a great example. They do water treatment and hygiene services. Almost any commercial kitchen or hospital you walk into, you'll see an Ecolab sanitation dispenser. They are so deeply embedded in everyday life.
Right. And then you've got energy with Exxon and Chevron, real estate, utilities, communication services. But I think the most fascinating part of this list, psychologically speaking, is the consumer sectors.
Oh, the dichotomy there is brilliant. It is a masterclass in behavioral economics.
Yeah.
You have consumer discretionary on one side and consumer staples on the other. And they perfectly track how human beings change their spending based on how secure they feel.
Let's break down discretionary first. The name kind of gives it away. It's optional. It relies entirely on disposable income.
Exactly. Consumer confidence. This sector is companies like Tesla, Amazon, Nike, Starbucks, Marriott Hotels. When the economy is booming, unemployment is low, wages are up, credit is cheap, people feel wealthy.
They exercise their discretion.
Yes. They buy the electric car, they upgrade their wardrobe, they book the luxury vacation. So during economic expansions, consumer discretionary stocks just explode with growth.
But then the macroeconomic winds shift. Inflation spikes or massive layoffs hit the news, and that psychological confidence just evaporates.
Instantly. You cancel the vacation, you drive your old car for another 5 years, and you stop spending $6 on a latte every morning. The discretionary sector takes a massive beating.
Which is exactly where the consumer staples sector steps in to save your portfolio.
Right, because consumer staples represent absolute, non-negotiable human necessities. These are the companies producing the things you have to buy just to survive, regardless of what the stock market is doing.
It's I still need to wash my clothes and buy toilet paper, even if the economy is collapsing.
Precisely. Walmart, Costco, Procter & Gamble, Colgate. In a brutal recession, a family will cut all their fun spending, but they will never stop buying laundry detergent or basic groceries. So the revenue streams of these staples companies are incredibly resilient. They act as a defensive anchor for the S&P 500 when everyone is panicking.
It's so smart. By owning the whole index, you are basically hedging against human psychology. You profit from their optimism with the discretionary sector, and you're protected by their bare necessities with the staples sector.
And there's one more layer of diversification here that beginners often miss. Because the number one rule of the committee is that a company has to be domiciled in the U.S., people assume the S&P 500 is a purely American asset, right?
Yeah, totally dependent on the American consumer.
But that is a complete mathematical illusion. These are multinational conglomerates with massive global reach.
Right. Because a farmer in Brazil is still using Microsoft Windows. A student in Japan is Googling things. Families in Europe are drinking Coca-Cola and paying for it with their Visa cards.
Exactly. When you actually aggregate the revenue data, roughly 40% of all the money generated by S&P 500 companies comes from outside the United States. So when you buy an American index fund, you are secretly capturing global economic growth. You're betting on the rising middle class all over the world, but you still get the safety of strict U.S. regulatory and accounting standards.
Okay, so we've mapped out the architecture. It's a self-cleansing, committee-run list of 500 global powerhouses, weighted by gravity, spanning every human need. The structure is honestly elegant, but structure alone doesn't explain why financial advisors practically worship this list. That reverence comes down to the raw historical data.
The data is completely unequivocal. Since its inception in 1957, the S&P 500 has delivered an annualized average return of about 10 to 10.7%.
I really want people to internalize the scope of that timeline. 1957 to today. That 10% average includes the stagflation of the 1970s.
It includes the 1987 Black Monday crash,
The dot-com bubble bursting.
the 2008 global financial crisis,
And the 2020 pandemic lockdowns. Through every conceivable geopolitical disaster, war, and inflationary spike, the mathematical aggregate of these 500 companies has marched upward at roughly 10% a year.
and the most important part of that 10% return is how you achieve it. It is entirely passive.
Which brings us to the great philosophical war of Wall Street. Active versus passive investing. For decades, the industry sold us on active management. Like, the image in pop culture is always the chaotic trading floor, right? Guys in suits screaming into phones, trying to predict the future.
Right. Active management is based on the idea that highly educated analysts with complex algorithms can spot market inefficiencies and pick the exact stocks that will beat the average. And, of course, they charge you huge fees for their supposed genius.
Naturally.
Passive investing is the complete opposite. It concedes that predicting the future is basically impossible. So instead of trying to find the needle in the haystack, passive investing just buys the entire haystack.
And to prove how fragile that active management illusion is, we have to look closely at that Warren Buffett wager we teased earlier. The data from this bet completely shatters the active management myth.
It really does. So in 2007, Warren Buffett, who ironically became a billionaire as an active stock picker, issued this public challenge. He offered $1 million to any firm that could select a portfolio of hedge funds that would beat a basic, low-fee, unmanaged S&P 500 index fund over 10 years.
And a firm called Protege Partners stepped up.
They did.
Yeah.
And they didn't just pick a few random stocks. They used a fund-to-fund strategy. They picked 5 elite hedge funds, which contain hundreds of underlying investments, managed by the absolute brightest mathematical minds money could buy. They had every advantage, complex derivative strategies, the ability to short the market, everything.
And they had a full decade to prove it.
So what were the final audited results when Buffett published his 2017 shareholder letter? Keep in mind, this decade included the 2008 financial collapse.
Right. So over those 10 years, the passive robotic S&P 500 index fund generated a cumulative return of 125.8%.
It more than doubled the initial investment without even thinking. And the elite hedge funds, the 5 hedge funds generated returns of 2.8%, 7.5%, 22%, 27.7%, and 87.7%. Every single one of them was absolutely demolished by the passive index.
It's just a profound mathematical disconnect. How do rooms full of Ivy League economists with supercomputers lose that badly to a dumb list?
It comes down to 2 main factors: market efficiency and the parasitic drag of management fees.
Let's unpack the efficiency part first.
Sure. The modern stock market is incredibly efficient. Information travels globally in milliseconds. By the time a hedge fund analyst uncovers a piece of positive news about a company, the stock price is already adjusted to reflect it. Finding a genuine, exploitable edge is exceedingly rare.
And then there are the fees.
The fees are the anchor. Hedge funds famously use a 2 and 20 fee structure. They charge a flat 2% annual fee on all your money just for existing, and then they take a 20% cut of any profits they generate.
Wow. So even if they do manage to beat the market by a tiny bit, they just confiscate that advantage immediately.
Exactly. The client is left with a net return far lower than the S&P 500, which charges a fraction of percent in fees.
It's incredible. But listen, there's another mechanical superpower built into the S&P 500 that drives that 10% average. And I feel like beginners always overlook it because it doesn't involve the stock price actually going up. We have to talk about dividends.
Dividends are crucial. They're a huge part of your total return. When a massive, mature company like Coca-Cola or Johnson & Johnson reaches a certain scale, they can't possibly reinvest all their profits into building new factories. There's a limit to their growth.
So they just give the cash back to the investors.
Right. Every quarter, they take a chunk of their cash profits and distribute it directly to their shareholders.
Literally just depositing cash into your brokerage account.
Yeah.
But the real wealth-building magic happens when you refuse to spend that cash. Our sources talk about a specific automated mechanism called DRIP.
DRE, the Dividend Reinvestment Program. This is the mechanical engine of compound growth. When you turn on DRP in your account, the software intercepts that cash dividend the second it hits, and it instantly uses it to buy more fractional shares of the S&P 500.
It happens completely in the background.
Completely automated. You don't click a thing.
It's a self-replicating system. Your shares generate cash, DRIP uses the cash to buy more shares, and then next quarter, those new shares generate their own dividends, which buy even more shares. You are slowly acquiring a larger percentage of the American economy without actually adding any new money from your paycheck.
And that combination, the stock price going up plus reinvesting the dividends, is exactly why the S&P 500 acts as the ultimate shield against inflation, which is essentially a stealth tax on your wealth.
We definitely need to address inflation. It is the silent killer. Historically, inflation is around 2%, but obviously we've seen it spike way higher recently. If you take $10,000 and hide it under your mattress or in a regular checking account, you aren't just missing out on growth, you are actively bleeding purchasing power.
Oh, absolutely. In a decade, that money will buy significantly less food or housing.
But the S&P 500 neutralizes that. How?
Because the companies in the S&P 500 are the ones driving the inflation. When raw materials get more expensive, Procter & Gamble just raises the price of their toothpaste. When labor costs go up, Amazon raises the price of Prime. Their profits naturally expand in tandem with inflation. So by owning their stock, your wealth expands alongside the rising cost of living.
Okay, so the S&P 500 averages 10%, it destroys hedge funds, and it shields you from inflation. But human brains are really bad at understanding exponential math. 10% a year sounds nice, but it doesn't intuitively sound like, retire on a yacht money.
It really doesn't.
To bridge that gap, we need to look at the raw mathematical reality of compound growth over time.
Compound growth is often called the eighth wonder of the world. It's the concept that the returns you make on your money start generating their own returns, creating this accelerating upward curve.
I always use an analogy for people who hate looking at spreadsheets. Imagine your money is an employee. Every time you invest, you're sending an employee to work. In the first few years, your employee is just doing their job, making a modest return. But eventually, the money your employee makes, the returns, starts acting like a new set of employees.
Right. Your money hired a team.
Exactly. And then that team generates more returns, hiring their own team. Fast forward 20 years, and this massive army of returns is working exponentially harder than the original cash you put in.
That is the exact mechanical reality. And our sources gave us 3 really distinct, rigorous mathematical scenarios to show how this plays out. Let's look at scenario 1, the early starter.
Walk us through it.
Okay, so imagine a 20-year-old. They decide to invest just $50 a month into an S&P 500 fund. That's like, what, $1.67 a day? Less than a coffee.
Very doable.
They automate it, and they never increase that $50. Assuming the historical 10% average, they keep this up until age 65. That's 45 years of compounding.
Let's separate the principal from the growth here. $50 a month for 45 years. That's a total out-of-pocket contribution of $27,000, which, over a lifetime, is nothing.
It's remarkably small. But because of compound growth, their final account balance at age 65 isn't $27,000. It's approximately $379,000.
Nearly $400,000 from $50 a month. The money did over 90% of the heavy lifting.
Now look at scenario 2, which is a brutal lesson in behavioral economics. This is the exact same person, but they decide their 20s are for having fun, and they'll wait until they turn 30 to start investing. At 30, they start putting in the exact same $50 a month, getting the exact same 10% return, retiring at 65.
So they only missed 10 years of a $50 payment. 10 years times 12 months times $50. They only saved $6,000 in actual out-of-pocket cash by waiting.
Correct. Their total out-of-pocket is $21,000 instead of $27,000. But their final account balance at age 65 collapses from $379,000 down to just $138,000.
That is a staggering penalty. By waiting just 1 decade, they gave up $241,000 in final wealth, just to keep $6,000 in their 20s.
It proves that your most powerful asset isn't your salary or your intelligence, it is time. A compound interest graph looks like a hockey stick. The first decade is flat and slow, but decades 3 and 4 curve violently upward. When you delay by 10 years, you aren't cutting off the slow years at the beginning. You're amputating the violent exponential explosion of wealth at the very end.
That completely redefines how you look at cost. Like buying a luxury car in your 20s doesn't just cost the price of the car. It costs the hundreds of thousands of dollars that money would have made in its final decade of compounding.
Absolutely. Now let's scale it up to scenario 3, the millionaire math.
Let's hear it.
This investor starts at 20, but they commit to $500 a month. That takes discipline, but it's highly achievable for a dual-income household. $500 a month at a 10% return. Under those parameters, it takes exactly 31 years to cross the $1 million threshold. By age 51, their total out-of-pocket contribution is about $186,000.
And the investment returns?
Over $900,000. Their total account balance sits at $1.09 million.
The math doesn't care about your background or your connections. It just works. Which brings up the ultimate question. If the system is this accessible and the math is this undeniable, why isn't everyone doing it? Why are people leaving their money to rot in checking accounts?
It's almost entirely driven by psychological barriers and financial misinformation. There are 3 persistent myths that kill beginner investors before they even start.
Let's systematically bust these myths. Myth number 1, I need a ton of money to start. I don't have $500 a month or even enough to buy a single share, so I'll just wait until I'm rich.
Decades ago, that was mathematically true. Brokerages charged massive fees, and you had to buy whole shares. If a stock cost $400 and you only had $100, you were locked out. But modern technology has completely eradicated that barrier with fractional shares.
Explain how a fractional share actually works. Because if the stock is $500, how can I buy $1 worth?
It's a ledger system. When you use an app like Fidelity or Robinhood, you place a $1 buy order. The brokerage pools your dollar with thousands of other small orders, goes to the market and buys the whole $500 share. They hold it in their master account, and internally they assign you a fractional slice, in this case, 1/1500th of that share.
And does that tiny slice still grow at 10%? Does it still pay a dividend?
Yes. It gets the exact proportional growth and the exact proportional dividend, which gets reinvested. The democratization of investing is complete. If you have $1, you can be an owner of the S&P 500. So myth 1 is dead.
Okay, myth 2, the barrier of fear. The stock market is a casino. It crashes violently, and I could lose everything overnight. We have to be honest here because market crashes are real and terrifying.
We cannot minimize the trauma of a crash. In 2008, the S&P 500 lost about 50% of its value. In March 2020, during the pandemic, it plunged 34% in weeks. Seeing half your net worth vanish on a screen induces absolute panic.
So how do we reframe that so it doesn't paralyze people? How is a 50% drop not a permanent loss?
You have to understand the difference between temporary volatility and permanent capital loss. The media fixates on the crash, but they ignore the recovery. Every major crash in S&P 500 history has been fully recovered and exceeded. The 34% dropped in 2020, fully recovered in 5 months. The devastating 50% drop in 2008 took about 4 years to recover and then launched the longest bull market in U.S. history.
The loss only becomes real if you capitulate. If the market drops 50% and you panic and click sell, you have locked in a permanent loss. But if you do nothing, you still own the exact same number of fractional shares. Their businesses recover and the price follows.
This is why sequence of returns risk is important. Temporary volatility means nothing to a 30-year-old investing for retirement. A crash is only dangerous if you are forced to sell at the absolute bottom just to pay rent.
Which is exactly why you need an emergency fund first. 3 to 6 months of living expenses in a boring high-yield savings account. That cash is your firewall so you never have to touch your investments during a recession.
And if you have that timeline protection, the history is incredible. Over any rolling 15-year period in S&P 500 history, the market has delivered a positive return. Even if you invested all your money on the worst possible day in 2007, right before the whole system melted down, if you just held it for 15 years, you still came out ahead.
Which transitions perfectly to myth 3, the illusion of control. I'll just hold my cash and wait for the crash so I can buy in at a massive discount.
Attempting to time the market is the most mathematically destructive habit a retail investor can have. Predicting a crash requires omniscience.
Our sources actually cite this phenomenal study by the Schwab Center for Financial Research that mathematically destroys the idea of market timing. They modeled a 20-year period with an investor who had historically catastrophic luck. This person saved $2,000 a year. But instead of investing it normally, they tried to time the market, and ended up deploying their cash on the absolute worst day of the year, the exact peak before a massive sell-off. And they did this every single year for 2 decades.
And the results are completely counterintuitive. Even this extraordinarily unlucky investor who bought at the absolute top every year generated significantly more wealth than an investor who was so terrified of crashes that they just left their money in cash.
Because even buying at the peak captures all that subsequent compounding recovery. It proves the old Wall Street maxim, time in the market beats timing the market.
And macroeconomically, it makes sense. Humans hyper-focus on negative events, but human innovation trends upward. U.S. economic expansions, when businesses are growing and hiring, last significantly longer than recessions. The expansion starting in 1991 lasted 120 months. The 2009 expansion lasted 128 months.
And the recessions before that.
A mere 8 months and 16 months. When you wait for a crash, you are betting against an economic machine that grows for a decade and only shrinks for a year. Trying to dodge the 8-month shrink usually means you missed the 120-month expansion.
Okay, the barriers are destroyed. You don't need a fortune, crashes are temporary, and market timing is foolish. The theoretical part is over. Now, what is the actual playbook? What buttons do I press right now to become an owner of the S&P 500?
Step 1. Understand the vehicle. You can't just buy a stock called the S&P 500. It's a mathematical concept.
Yeah.
You have to buy a financial product that tracks it. Today, the best vehicle is an ETF, an exchange-traded fund.
I'll use a tangible analogy for this. Imagine you wanted to invest in your city's restaurant industry. You want a tiny fraction of all 500 restaurants in town. If you did it manually, you'd have to negotiate 500 legal contracts and monitor 500 accounting ledgers. It's impossible. But if a massive firm buys a piece of all 500, bundles them into one master contract, and sells you a share of that bundle, that is an ETF.
That's exactly how it works. Massive firms build these ETF to track the index perfectly. The big three you'll hear about are VOO, managed by Vanguard, SPY, managed by State Street, and FXAIX, managed by Fidelity.
So if a beginner sees VOO, SPY, and FXAIX, how do they choose?
In terms of assets, they're identical clones. They hold the same 500 companies in the same proportions. The only difference is the expense ratio.
The annual fee they charge you to manage the bundle.
Right. The industry average for active mutual funds is around 0.79%, sometimes over 1%. But these S&P 500 ETFs are automated, so the fees are microscopic. SPY charges 0.0945%. Vanguard's VOO lowers that to 0.03%.
Let me translate 0.03% into real dollars. If you invest $10,000 into VOO, Vanguard charges you exactly $3 a year. $3 to manage the 500 greatest companies in America and automatically reinvest your dividend.
And Fidelity's FXAIX pushes it even lower to 0.015%. Honestly, the difference between VOO and FXAIX is pennies. Pick one at random. The vehicle matters much less than the tax environment you put it in.
Ah, yes, the final boss of wealth building, the IRS. Because if you just open a standard brokerage account and hit that millionaire scenario we talked about, $900,000 in profit, Uncle Sam is going to want a massive cut.
A standard taxable account offers zero shelter. When you sell those shares in retirement, you trigger capital gains taxes on every dollar of profit. That can reach 20% federally. On $900,000, you could instantly owe the government $180,000. Plus, you pay taxes every year on the dividends.
We need a bunker to shield this wealth. What's the alternative?
The mathematically superior environment for long-term growth is a Roth IRA.
Explain how a Roth IRA completely inverts the tax timeline.
With a traditional account, you defer taxes now but pay later. A Roth IRA requires post-tax dollars. You fund it with the money left in your checking account after your employer already took out income taxes. Because you already paid taxes on the seed money, the government promises they will never tax the harvest.
So it compounds for 3 decades, dividends reinvest tax-free, and when you're 59 and a half and you withdraw that $1.09 million, zero capital gains tax.
Zero. Every single penny is legally yours. It is arguably the most powerful wealth-building loophole for the working class.
Okay, let's turn this into an actionable checklist.
Step 1. Select a brokerage platform. Fidelity, Vanguard, Robinhood. It doesn't matter. Just pick one. Step 2. Open the correct account. If it's for retirement, open a Roth IRA. Step 3. Transfer your initial capital from your checking account.
Step 5. Search for VOO, SPY, or FXAIX. Step 5. Buy fractional shares. Don't wait until you have $500 for a whole share. If you transferred $75, buy $75 worth of VOO.
And the final step, which guarantees success.
Yeah.
Systemize it with dollar cost averaging, or DCA.
DCA is the ultimate hack. You just set the app to automatically withdraw, say, $50 every Friday, and instantly buy more of the fund.
It removes all human emotion. When the market is high, your $50 buys fewer shares. When a market crashes and everyone is panicking, your $50 automatically buys more shares at a huge discount. You average out your entry price over decades, completely insulated from the news cycle. Ensure DRIP is on, and then just go live your life.
You just let the automated machinery of corporate America do the work. Eventually, closer to retirement, you might add some bonds to reduce volatility, but for the accumulation phase, this is phenomenally effective. It democratizes wealth. You don't need complex math, insider knowledge, or a huge time commitment.
It really does. But before we wrap up, I want to leave you with a profound theoretical dilemma based on everything we just discussed. We've proven passive index investing destroys active stock picking. The low fees and automation win every time.
The data is ironclad.
But here's the paradox. An index fund is passive because it blindly buys Apple based entirely on its current market price. The algorithm never asks why Apple is $268, it just accepts that as reality. But who actually dictates that price?
The active traders, the hedge funds, the analysts reading earnings reports, fighting over the price. Their combat creates the price discovery that sets the market cap.
Exactly. The passive index funds completely rely on the active traders to set the correct prices. But if passive is mathematically superior and capital keeps flowing out of active management and into passive funds, what happens? If active traders eventually go extinct because they can't beat the index, who is left to figure out what these 500 companies are actually worth? Does the massive success of passive investing eventually break the stock market?
Wow, that is the ultimate systemic paradox. The passive machine needs the active players to function, but it's slowly starving them of capital. Something to just kind of mull over while your automated deposits quietly compound in the background. Look, you don't need an aerospace engineering degree to fly, and you don't need fluent Wall Street jargon to capture global economic growth. Build your bunker, automate your investments, and let the mathematical gravity of the S&P 500 do the heavy lifting. Thank you for joining us on this deep dive, and we'll see you next.